Alright guys, this is Open Interest Part 2 of the Tradehouse Sniper course. This is John Phibb, and this is the last video you will be receiving from me. Special thanks to Larry Williams for writing about open interest in one of his books published in 1979 called How I Made $1 Million Last Year Trading Commodities. Also, a special thanks to barchart.com for allowing users to have a free account and to study open interest. And last but not least, a special thanks to investopedia.com for allowing traders and investors access to their dictionary, which is extremely useful as it explains many of the concepts we use in our personal trading. Thank you for being a reliable and credible source of financial related information. So, what is open interest? As per investopedia.com, open interest is the total number of outstanding derivative contracts such as options or futures that have not been settled for an asset. The total open interest does not count and total every buy and sell contract. Instead, open interest provides a more accurate picture of the options trading activity and whether money flows into the futures and options market are increasing or decreasing. My level of understanding, based on Larry Williams' book and what he has taught, is that a decrease in open interest means commercials are releasing shorts, okay, which is bullish. And a rise in open interest is an increase in shorts, which would be bearish. As with other smart money concepts, it is a good idea to combine multiple concepts together that point to the same direction. This does not mean to force the market to bend to your will. We are at the mercy of real smart money. They are the ones who decide what price is going to do next. Our job is to identify what is most likely going to happen next based on clues like open interest. In order to increase our level of understanding, we must look at past price history and identify previous moves to help determine the next big move. And next up, charts. Okay, so we're looking at crude oil, all right, and currently this is the August of 2020, and that's the symbol CLQ20. And if you're viewing this in a few months from now, that symbol may not be available. But at the time of this recording, on July 5th, 2020, that is the current symbol. So I want to give you an opportunity to look at this chart based off of the information that I gave you already and to be able to see if you could tell where oil was able to bottom out. And so we pointed to the fact that a rise in open interest would be bearish and a drop in open interest would be bullish. So if you want to challenge yourself, as always, it's a good idea to pause the video here and to really look at this chart and determine, based off open interest, okay, where the low was set. And it should be obvious because there's only one low. There's only one major low on this whole chart, okay, near the $20 mark, okay? And so when you look at that low near the $20 mark, look at open interest, which is the black line on the bottom. All right, so right here on the bottom between April 13th to April 27th, okay, right in between there in the pink circle, there is a massive decrease in open interest. So we see the number basically go from almost 2.4 all the way down to 2.2. Um, I'm no math genius, but I think that's a little bit less than 10%. I'm not really sure. And in his book, I believe he says to mention, or I believe that he mentions that you want a 15% or 20% or more decrease in shorts. But I think this setup was a little bit different. We this year, for the year of 2020, we were able to see something that we've never seen before in the crude oil markets. We did have a couple of the contracts, one of the delivery months or more of the delivery months actually went into the negative pricing. Okay, so things were a little bit different this year. And we talked a lot about that on the sessions around the time that this was happening and a little bit afterward. If you guys remember, I was mentioning that I picked up some Halliburton stock back then and things of that nature because I believe their stock price correlates with oil. So I was looking to go long oil, but I put money in a stock instead of actually buying oil. All right. And so there is your large drop in open interest. And then, like I said, oil around $20. Now, the reason that I threw in there that everyone is affected, because that is such a small statement, and we could talk all day about what that really means. It just means that when oil is that low, there's really not a whole lot of people who benefit from oil being that low. I know we talked about in previous sessions basically the price war between Saudi Arabia, OPEC, Russia, and things of that nature. And so when oil is $20 a barrel, nobody makes money, all right? And it's not good for oil to be that low. And so if basically countries want to make money from oil again, the price of oil has to go back up. Okay, and you can do some price history study on that. You can study the 08, 09, what happened with oil in 2008, 2009, and things like that. But so even though we were able to see historic lows for oil, we were able to help determine where the bottom would be, um, and not mentioning the gap as well between March 2nd and March 16th on this chart. Okay, around that $43 mark. There's a big gap on the chart. Okay, and there you have it. So that was your um, basically the low that was set for oil, and it was able to essentially go from 20 all the way back up to 40 in just a few weeks. Okay, so even though this move doesn't look like much, it is. Okay, very, very big. And just to go a little bit further, you can look at the top left, okay, and you can look at the pricing right below crude oil, right? You can see that there's some bullish pricing in here, but the range of these candles is very small compared to the range from over here. Okay, so don't let the chart fool you. All right, these are major, major moves in the market. Okay, so moving forward, we are looking at the dollar index. All right, there you have it. Now, I want you to look at this one as well. And kind of the same thing of what we're doing with oil. Okay, there's only one low, one major low that was set in this whole chart. Okay, and it should be obvious for you around February of 2018 all the way to April of 2018. So for those of you who don't know what I'm talking about, it's this over in here. And this is a daily time frame. Okay, so this is very, very large time frame stuff. Okay, so in Larry Williams' book, he does talk about periods of consolidation, and he talks about whether open interest is decreasing, then we're bullish, and if it's increasing, then we're bearish. All right, and that's literally straight from the book. I'm not trying to make anything up here. Okay, you want to study the people who have what you want, right? And Larry has what I want, so that's who I listen to. Okay, and so when you study this chart, all right, like I pointed out, here is your consolidation between about 88 to 90. Price was fluctuating in between there. And so during that period, if you look at the open interest on the bottom, right, just during the times of that consolidation, okay, you can see that open interest was actually decreasing. So Mr. Williams was correct. Even though the book was written in the late 70s, here we are in February of 2018 with the dollar index basically calling the move. All right, so there you have it. In that consolidation, once price was able to break out, you can see that the dollar index, once it finally left that 90 level, if you look all the way on the right side of the chart, that dollar index went almost all the way to 100 just based off of this data. So now what does that mean? For us, even though we don't trade the dollar index, we're able to trade the euro. So that means the euro probably set a high and was able to essentially fall off the face of the earth. All right. So go look. Okay, go look for that scenario. And if you want some extra homework, I'll throw in a nugget for you, but I won't do the homework for you. Go study this same time period. Go look at Euro USD and go look at GBP USD. Okay, for those of you familiar with divergences, go ahead and go take a look at that. All right. But moving forward with open interest, we need to go ahead and look at another chart. And I didn't have any animations on these, so sorry about that. I usually enjoy those, but nonetheless, here we have gold. Now, gold is a little bit different. Now, why would I say that? Well, if you've seen my seasonality video, which I hope you have, okay, you guys know what we look for in gold and silver at the end of the year. Okay, so there's actually multiple years on this chart, but I'm only going to show you one example here, which is the one that I was able to call last year. Well, I called the bottom for gold and silver the last 4 years in a row. So the most recent year, okay, last year in 2019, I think it was December 17th, right? I actually met some of the Houston squad. We actually met up at a Starbucks, and I let them know, hey, you know, gold and silver should be rallying into February. And if you haven't seen that video, then you need to. But if you have seen that video, you know exactly why we would be looking for gold and silver to rise at the end of the year into the new year. Now we can help identify high probability by looking at open interest. Okay, so I know there's a lot of open interest going on, but nonetheless, if you look around the November of 2019, okay, and you see that little small consolidation in there, it's right here, right? This is what I'm talking about right here. Okay, so look inside of this consolidation here. And even though this is on the daily, of course, you can go back into your own charts. You can see there's institutional candles here. All right, that led to this really nice move, which ended up setting the low for a long time. And I believe we're actually close to all-time highs for gold as well. But anyways, back to the point of the video, which is open interest. All right, we're going to go ahead and take a look at what open interest was doing during that time. So right in there around the 700K mark on open interest, okay, at the bottom black line, you can see that we were above 700K, and then we came back down to about, I don't know, 675K, something of that nature. I don't know the math on that. You can, you know, you're encouraged to go look at the math on that. I don't know what it is. To specifically say if it was 15% or 20% or more, I don't know. But to be honest, it really did not matter to me. I was just looking for that really big move, and we found it. Now, by the time that I found it, I was about 2 to 3 days late. So the return to the institutional candle was already like 2 or 3 days past it. So I was slightly late. But nonetheless, overall, there was still a lot of upside potential. And so you can see in here with the pink arrow, okay, gold rallied for a long time. Even though it consolidated, it had another markup, okay, all the way into March before we got this monstrosity in here, okay. But nonetheless, open interest here was able to, give us more confidence for that run higher into February. So with this specific setup, you would have had to have the fundamentals in mind, and those fundamentals being the February month, right? The supply and demand for gold and silver around February. So you would have had to, have your chart, and then you would have had to sprinkle, right, that fundamentals on the top. And then, of course, your open interest to help confirm, okay? So a lot going on. And I know it's only a once a year thing, but you guys also have to understand we have the rest of our lives to be trading. Okay, so I know a lot of you are, some of you are 18, 19 years old. Some of you are in your 20s like me, or near your 30s. And even if you're in your 30s or 40s, guys, you're still young. You still have 20, 30, 40 years left of trading if you want to. So don't be upset that you missed a trade 1 year. Okay, there are other seasonalities that we can look at. That's not going to be for this video. I will show you one more as far as the seasonal part goes. But mainly we're looking at open interest today. All right. So there you have it. At least for the notes part of the presentation, seasonality plus the open interest is that whale trade, and that's what I've always been calling it since I started trading, was the whale trades. And the reason I call it that is because it comes back to that saying, you give a man a fish, he eats for the day. But if you teach a man to fish, he feeds himself for the rest of his life. And so when we're in there day trading or even swing trading, we're catching fish, right? We're catching small trades, compounding the account, and that's why I call it a whale trade, because this is essentially a one and done. You take the trade and you hold on to it for a few months and you catch that big whale of a trade. So it doesn't matter what you call it. You call it a monster trade. It don't matter. Okay. But the whale trade is that's what I call it. All right. So if you ever hear me say that term, that's what that means. Okay. Just a really, really long-term trade. All right. So now we're looking at the British pound. Let's see. This is B6N20. So I think this is the current contract as of the recording, but this was something that we were also able to talk about last year. I talked a lot about this with Rock Coomer on Rock's channel when I was on there every Friday near the end of 2019, and this was one of them. And I remember Jenna, okay, had called a trade out right in the middle of this as well. And it was a really good trade, and it was something that I should have held a little bit longer. So I kind of goofed on that, but we all make mistakes. But as long as you are able to identify your mistakes, learn and grow from there, then you're doing a good job, in my opinion. So there you have it. I'm not perfect. Okay, so, but nonetheless, I know there's a lot going on this chart, and I'll go ahead and just give it to you here. Well, I did say October of 2019, so your eyes should have went right to October of 2019. But if you haven't seen it already, I'll go ahead and point it out to you here. Okay. So on the bottom, our open interest really took a nosedive from 300K down to like 230, 235, maybe 240, something like that. It's honestly hard to tell, but that's a pretty big decrease. Okay, that's a pretty big decrease in open interest. So when you have that big of a drop off, after a long period of essentially having a bearish market, right? Because the market was essentially bearish since uh, like March, around March, April of 2019, and you can see that on the chart. All right, GBP went from like 3.4 all the way down to 1.2. Okay, so a couple thousand pips in there, or excuse me, over 1,000 pips in there, something like that. So the market was really ready to reverse. Um, and so this is another seasonality plus open interest for that whale trade. Now, I've only shown you open interest, so why would I say seasonality as well? Because you have to look at your seasonal chart. And I usually don't show you guys the seasonality charts, but I do give you the reference to where it's actually from. So for the sake of the video, okay, because it's the sniper course and I'm introducing to you, how it is that we're able to do what we do, I will show you one seasonality chart, okay? Of course, courtesy of equityclock.com, okay? So here is your British pound Forex seasonality, all right? And just like I told you, we're looking at the time. Okay, so we're looking at October of 2019. So when you look at open interest, you see the drop. When you look at the chart, you see the British pound is able to retrace a little bit. Okay, what I'm talking about is right here, right? Open interest drops. Price was able to come down a little bit after this really big bull run. Now, if you go and you study your own charts, which I hope you do, there's also an imbalance right here as well on the daily. And so right when that imbalance fills here, okay, what do you notice about the seasonality of British pound? We need to look at October. So what does October show you? Oh, that a low is supposed to be set in the beginning of October. So seasonality let us know well in advance, right? We knew what October was supposed to do back in January because it's an average seasonality chart. So we already knew that was coming. Now we anticipated, or hopefully next year and every month that you do this, you anticipate that move coming. Then you can use open interest to help determine what smart money is doing. So in this scenario, right, they were decreasing shorts. Why would they decrease shorts? Well, if they're anticipating bullish pricing, right? So obviously in this chart, British pound goes from, what is that, 2.2, something like that, 2.2, all the way to 1.35, right? And it was able, British pound was essentially around Christmas time, maybe a little bit after Christmas, meaning the end of December, was around the 1.35 mark. So very, very explosive moves. Again, this is a daily time frame, so there's massive pips to be made here. But that's how essentially you would combine seasonality with open interest. But of course, price is always king. So if you typically, what I do is I look at price first, okay, because price is king, and then I'll take a look at the seasonality chart. Okay, what are we expecting? All right, if we're expecting that, can I get some fundamental data to help prove that that's what we're doing? Boom, open interest. Okay. Now, it's not going to be a next day or 2 days or 3 days later. You got to give it a little bit of time. Okay, because open interest, if you look at the data, open interest dropped off, a couple weeks before the low was even set. So there was that I'd say 2.5 week window of opportunity to be able to get in. So it's not just, well, I didn't look at it on Monday or Tuesday, so I'm going to forget about it. Nah, don't do that. Don't do that. All right. I found it pretty useful to look at seasonality, look at open interest probably every weekend or maybe even twice a week. Um, maybe if you want to incorporate this is just a suggestion. Maybe take a look on Saturdays and Wednesdays. You know what I mean? Where you just briefly overview seasonal charts, open interest, see if you find something juicy. All right. And then go from there. All right. And there you have it. So, seasonality is a great guideline for upcoming whale trades, which is just a fancy word for extremely large moves. Okay, we went over that. And OI is a confirmation tool to identify that smart money is in the move. But, as always, remember that price action is king. If price action is not aligning with the data, and that goes for seasonality or open interest, then listen to price and go from there. This is not a day trading strategy. This is for long-term trading. And just for a suggestion, meaning 60 to 90 days or even more, depending. Okay, so, and that's if swap doesn't eat you alive. Okay, so I've seen some people hold trades for long periods of time, and swap ended up taking like 33% of the profit. But if that's something you want to do, then that's something you want to do. So I won't tell you what not to do. Okay, so there you have it. All right, there you have it. All right, this is the final lesson of this sniper course provided by me, John Fibonacci. It has been an amazing experience sharing my knowledge and experience with you all. I hope the information you have been provided with is able to increase your understanding about the markets and how they operate. I encourage each one of you to keep your notes and to actually study them. Many years from now, you will look back on your experience and will be glad that you ever got started. I'm also forever grateful for my trading mentors, such as Larry Williams, George Angel, Lawrence Connors, John J. Murphy, Sam Seiden, and of course, many others. But above all, I am grateful for my trading family, Tradehouse. Thank you guys for being here. I appreciate you, and I will see you all on the bounce back sessions.